What if Africa controlled its money and future? In Dakar, Lagos, Nairobi, and Abidjan, the same quiet ritual happens every day. People work, trade, save, and plan their futures using money that feels local, looks national, and circulates daily. Yet the deeper control over that money often sits somewhere else, governed by rules most citizens never voted for and rarely see. Money feels neutral, it feels technical. But money is one of the most powerful political tools ever created. This is Africa Unrestricted. Monetary sovereignty aligns tools with goals. It matches interest rates, exchange policy, and payment rails to domestic priorities, employment, industrial learning, and resilience, rather than purely external comfort. Without that alignment, every shock becomes a budget crisis. Today's episode is about monetary sovereignty, not as theory and not as nostalgia, but as a practical examination of how African economies are constrained through currency systems, why these systems persist, and what changes when countries decide to take monetary control seriously. Monetary sovereignty begins with a simple question. Who controls the rules of money? Not just who prints it, but who sets interest rates, who guarantees reserves, who absorbs shocks, and who decides what happens during a crisis. In many African countries, those decisions are either externally influenced or structurally limited. This is not always obvious during stable periods. It becomes painfully clear during inflation, currency shortages, or external shocks. Dependence concentrates veto power. When reserve adequacy or lender sentiment decides whether hospitals or railways proceed, policy becomes risk-averse. Gatekeeping isn't just costs. It's the narrowing of what leaders dare to attempt. As of the early 2020s, more than 40 African countries relied heavily on foreign currency reserves, mostly US dollars or euros, to stabilize their economies. This dependence shapes everything from import prices to government budgets. Money, in this context, is not just a medium of exchange, it is a gatekeeper. To understand how this system formed, we have to go back to how post-colonial monetary arrangements were constructed. In several regions, newly independent states inherited currency systems designed to prioritize external stability over domestic flexibility. These systems were praised for discipline and predictability, which is another way of saying they reduced policy freedom. In the CFA system, external convertibility reassures investors but externalizes adjustment. When terms of trade swing, domestic firms carry the pain through credit rationing and wage compression instead of exchange rate cushions. The CFA Franc zone offers a clear illustration. Several West and Central African countries share a currency whose reserves were historically held largely outside the continent and whose convertibility was guaranteed externally. The arrangement was presented as stability. What it removed was monetary autonomy. African governments were told this was a fair trade. Stability in exchange for control. Interestingly, no major economy accepted this trade-off during its own development phase. Constraints operate through transmission channels. Bank funding in foreign currency, import price pass-through, and procyclical capital flows. Without a domestic lender of last resort in the settlement currency, recovery is slower and shallower. This is not an argument about symbolism, it is about mechanics. When a country cannot adjust monetary policy to respond to local conditions, it relies more heavily on fiscal measures, borrowing, or external assistance. During downturns, spending cuts arrive quickly. During booms, gains leak outward. As of 2023, Africa's total external debt exceeded $1 trillion, with debt servicing costs rising sharply due to global interest rate increases. Many African countries now spend more servicing debt than on health or education. This is not because money was wasted universally. It is because borrowing became the primary adjustment tool when monetary flexibility was limited. Pressure shifts onto fiscal space. Governments cut capex first, the exact spending that raises productivity. Then growth slows, tax takes shrink, and debt ratios look worse. The trap appears moral, but it's mechanical. When money cannot move, pressure moves elsewhere. Here is where the system becomes quietly self-reinforcing. African countries are encouraged to maintain currency stability to attract investment. To maintain stability, they must hold foreign reserves. To build reserves, they export raw materials and suppress imports. When global prices fall, reserves shrink. When reserves shrink, borrowing increases. The cycle continues. Africa is told this is prudence. It looks more like a treadmill. Alternatives start small. Local currency trade windows, swap lines among central banks, and regional netting platforms. Their value is optionality. Each new pathway reduces dollar demand at the margin and improves shock absorption. But this is not the whole story. Some African countries are beginning to test alternatives. In recent years, Nigeria has expanded the use of its local currency in regional trade, particularly within ECOWAS, reducing reliance on dollars for certain transactions. This has not solved Nigeria's challenges, but it has reduced exposure in specific sectors. Rwanda has pushed aggressively toward local currency settlements for domestic and regional trade, backed by strong institutions and fiscal discipline. The lesson is not perfection, it is intent. At a continental level, the African Continental Free Trade Area has quietly introduced frameworks to support local currency trade settlement systems. The goal is simple: reduce the need for African countries to use dollars to trade with each other. It is a strange arrangement when two African countries trade, and both must first acquire a foreign currency to do so. Strange, but normalized. Removing that requirement changes liquidity, costs, and bargaining power. The pause matters because distribution matters. If this message spreads, reform becomes less politically costly. Citizens start expecting payment systems and public banks to serve real production, not only balance of payments optics. Before we continue, a quick pause. If you've stayed with this video so far, it means this topic matters to you. Whether you're watching from Accra, Dakar, Nairobi, Lagos, Johannesburg, or the diaspora, this conversation only grows if more people hear it. If you want to support the work, liking the video helps, sharing it helps even more, and subscribing helps us keep doing this consistently. Even doing one of those makes a real difference. Alright, back to the video. Critics worry about inflation and credibility. Credibility is the capacity to deliver outcomes, jobs, stable prices, investment, not merely to satisfy ratings models. Institutions, rule clarity, and transparency anchor that credibility. Critics of monetary reform often raise familiar concerns: inflation risks, investor confidence, discipline. These concerns are not imaginary, they are also incomplete. Every country that controls its own currency faces these risks. The difference is whether it has tools to manage them. African countries are often advised to prioritize credibility with external markets over flexibility for domestic growth. This advice sounds technical. It is also selective. Countries that issue global reserve currencies are rarely asked to make the same sacrifice. Monetary sovereignty does not mean reckless printing or isolation. It means options. It means the ability to respond to shocks without immediately borrowing. It means financing development in local currency. It means aligning industrial policy, trade, and finance under one strategic roof. Countries that control money can make mistakes and correct them. Countries that do not control money are forced to endure them. Precedent shows sequencing: protect the current account, guide credit into tradables, and normalize temporary controls with exit criteria. The point isn't walls, it's scaffolding that's removed once industries stand alone. There is also a psychological dimension. When money is externally anchored, policy debates shrink. Leaders speak the language of constraints rather than possibilities. Development becomes something that must be approved rather than built. This mindset is learned. It can be unlearned. Consider how Asian economies approach development. Capital controls, managed exchange rates, and deliberate sequencing were common during their growth phases. These tools were not described as irresponsible then. They were described as strategic. Africa is often told the playbook has changed. Conveniently, the outcomes have not. Future pressure favors diversified settlement. Africa's bargaining power rises when buyers can pay in naira, shilling, or rand via regional clearing. That shift reduces currency mismatch and keeps value chains on the continent. The future pressure is clear. As global trade fragments and financial systems become more geopolitical, Reliance on a single external currency becomes riskier, not safer. Countries that cannot settle trade independently will find themselves negotiating from weaker positions. Africa's population, markets, and production base are growing. Monetary systems will either adapt or constrain that growth. Monetary sovereignty is not about rejecting the global system. It is about engaging it on equal terms. Money should serve development, not supervise it. Africa does not lack intelligence, discipline, or ambition. What it lacks is control over one of the most important levers of modern power. When that lever begins to move, many other constraints loosen quietly.